How the wealthy avoid paying taxes. Buy, hold, borrow, die is a shorthand phrase often used to describe how some wealthy individuals manage appreciated assets and taxes under current U.S. rules. The idea rests on a few basics. Investment gains aren't taxed until you sell. Loans are not taxable income, and at death, assets may pass to heirs with potential tax advantages. Advocates frame it as a way to access wealth without triggering income taxes, while critics see it as a policy gap with unequal outcomes compared to wage earners. A common example starts with buying a large position in a public company. Suppose someone purchases $1 million of stock and it grows to $10 million. The $9 million increase is an unrealized gain, and, under current rules, no capital gains tax is due unless the owner sells the shares. By contrast, if someone earned $9 million in wages, that would generally be taxed as ordinary income in the year it was earned. The timing of taxation, realized versus unrealized, creates a major difference in how wealth can grow. To access cash without selling, the owner can borrow against the appreciated asset. Banks often extend lines of credit secured by securities or real estate. Because loan proceeds are debt, not income, they are not taxed when received. In the scenario described, a person might borrow several million against the stock to fund purchases, then use real estate the same way. Buying a property, benefiting from appreciation, and later borrowing against that property as well. Throughout, if nothing is sold, there may be no realization event for tax purposes, though interest costs, collateral requirements, and market risks still apply. The final step centers on estate planning. Under current U.S. law, many estates benefit from an exemption amount before federal estate tax applies, and certain assets passed to heirs may receive a step-up in basis, meaning unrealized gains during the original owner's life might not face capital gains tax if the heirs sell soon after inheriting. The specific exemption amount and rules change over time, can vary by state, and are subject to policy debate and potential reform. The video's figures are illustrative. Actual thresholds and treatments depend on the year and jurisdiction. Supporters of this strategy emphasize compounding, flexibility, and the ability to fund lifestyles or investments without triggering taxable sales. Critics point to leverage risks, interest expenses, margin or collateral calls, and the broader fairness and revenue implications for the tax system. For most people, the practical takeaway is that taxes hinge on when gains are realized, how assets are financed, and how estates are structured. Anyone considering similar approaches should understand the risks and consult qualified tax, legal, and financial professionals. If you need a quick business or real estate loan, visit capitalventureloans.com. For more unique content, please like, share, follow, and subscribe.